What is up, ladies and gentlemen? In today's episode, we're going to take a step back and look at what is happening in the world of investment right now, because markets have turned back to red, investment values are dropping, and there's a lot of uncertainty out there at the moment. But on the other hand, we're also going to show you the income we've made in September and this year so far. And today we just spent 8,000 Rand on buying investments, and we acquired 12 shares in just a single morning. This episode is going to be jam-packed, so let's get started. I'm so glad you guys are joining Casual Cash today, because it's time to chat like a bunch of investors over a dining room table and just discuss what exactly is going on in the world and why. Compare our returns and what we plan to do with our investments to make some money. Alright, so let's get the ball rolling. You might have seen that some of your investments are in the red, right? Well, you're not alone. Right now the world is reeling a bit from some economic data that came out recently. The S&P 500 in America is down 9% just this month. The FTSE 100 in the UK is down 6%. And on the back of load shedding here in South Africa, our JSE 40 is down around 10%. All just in 1 month. So what does this mean and why is it happening? This is Casual Cash, so let's break it down simply. Remember, at the beginning of the year, we talked about inflation and how there were a few things affecting it. Basically, that coming off COVID and the war in Ukraine, the cost of goods and services were costing people more money. And then to add fuel to the fire, so to speak, the cost of oil skyrocketed when Russia invaded Ukraine and the world stopped buying their oil. That meant supply went down and prices went up. So all of this led to much higher inflation rates, meaning the cost of living went up for everybody, and the Reserve Bank was forced to raise their interest rates. That means everybody has to pay more for their cars and their houses and their credit cards. We've got a video with a bit more detail if you want to check it out, but long story short, the cost of living went up for everybody. And because of that, most companies will sell less products as people try to save and spend less, and companies are at the same time paying more for their debt. That, in a nutshell, is why the markets are going down. But just a couple months ago, markets were going up. So what happened now that the markets have gone down further? Well, if you want to laugh, let's take a look. So in the US, they were expecting inflation to lower to 8.1%, but the numbers came in at 8.3%. Yep, that's it. No, look, in reality, there is of course further reaching impacts, but that is the basics of it. Around the world, including here, inflation was expected to lower, and for the last few months it looked like it would. But when the numbers were released and it looked worse than people thought, and Reserve Bank said they would have to implement harsher interest rate hikes, it set off a whole new market decline, and that's where we are today. So if you're wondering why your portfolio is red, those are the basic reasons why. Inflation, cost of living, interest rates, etc. Okay, so now that we know all of that, what do we do as investors, and why exactly am I investing 8,000 Rand and buying 12 different shares in one day when the market is going down? That is a great question. And all of it comes down to two words, and those two words are patience and opportunity. You might have heard the saying that it's about time in the market and not timing the market. You might have also heard the saying that riches are made in recession. It is those two sayings which have been on my mind. I usually only invest with money that I don't need. The money you have left over at the end of the month that instead of spending you stash away. I also really enjoy income generating assets, as you know, and those are investments that pay you on an ongoing basis, meaning I often have money coming in from my other assets that I can choose to reinvest. And with that comes the ability to invest for the long term, to put money into the market when you feel there is value and wait until that value comes to realize itself. We've done the exercise before where we looked at all the major market crashes and how they have over time come to recover and beat their previous best, and how we wish we would have invested at the bottom of those markets. So for me, when the markets go down, as unsettling as it is, I also know it's a good time to buy shares at a discount so that when the markets eventually recover, you can make even greater returns in the years to come. Like the saying goes, riches are made in recessions. So as the markets dip, I like to take the opportunity, there's that second word, to top up my portfolio. I don't go wild, but it's an opportunity to dollar cost average, or in other words, to keep buying in to average your purchase price and lower your risk. Also, here's a tip: when prices are down, the dividends go up, in terms of percentage that is. So if a share pays 1% at 100 Rand, when it hits 50 Rand a share, the dividends are worth 2% when you buy it. So you guessed it, but that is exactly why I went into the market today to buy some shares, top up my portfolio, dollar cost average, and use the opportunity to get some dividend paying shares at lower prices to invest for the long term. This is what my investment income looks like for the year so far. From March to September, or roughly 7 months, we've brought in a bit over 15,000 Rand in income, so it was time to reinvest some of it. So here is the breakdown of the 8,000 Rand I invested today and the 12 places that I invested the money in. Alright, let's start with our 3 ETFs. You can see here we invested 100 Rand each into the S&P 500, the JSE Top 40, and the FTSE 100. If you follow the channel, you will know this is part of our stock market versus national lottery experiment this year, where we invest 100 Rand in each of these 3 ETFs and 100 Rand in the national lottery to see which one comes out on top. Then, as you also know, we've been investing in banks this year because as interest rates rise, so does the income of the banks. And already a couple of them have announced special dividends for this year, special distributions, some of which we've received here in December. So we've put 500 Rand in First Rand, Nedbank, Standard Bank, and Capitec, and the dividends are looking pretty good. Capitec is at a 2.2% dividend, up from usually 1 to 1.5%. First Rand is at 5.6%. Standard Bank at 7.2%, and Nedbank at a 7.7% dividend income. Then we also added to our Sanlam shares at 6.4% dividend income, and a little bit more, 790 Rand, into Storage at an 8.6% income, which is a REIT. Then we have our Satrix Property ETF. We added 1,000 Rand in there. How could you not, with dividend income of 13.5% currently? And also, we haven't invested in Fairvest since 2017, but we added an additional 1,000 Rand in there because 13.9% dividend is hard to pass up. And the last one, which is a new kid on the block, is Clientele, where we put in 2,500 Rand at a 10.8% dividend income. So in terms of our banks, our insurance, and our REITs, we have a 9.72% dividend income, and for the total of 7,790 Rand, we'll be bringing in about 757 Rand every year from those investments. So that brings us to a total of 8,090 Rand in 12 places that we invested, including shares, REITs, and ETFs. And that is it for today's episode. I hope you enjoyed it, and feel free to like and subscribe to the channel if you haven't already. But do keep an eye out for the next episode because I think it'll be incredibly exciting. But until then, I'll see you guys next time, as always, on Casual Cash. Cheers.